Yeah, you can start.
Okay, thanks, Joseph. Good morning, students. The purpose of this session is to complete the property, plant and equipment session that we had previously, where we could not finish it due to electricity crisis. But today we are actually dealing with them. We are dealing with the disposal of property, plant and equipment. So when we talk about disposal, we are getting rid of the asset. It's either we are selling it or we are scrapping it. If we have no use of it anymore. What is our golden rule then in terms of IAS 16, which is our International Accounting Standard 16? It tells us that the carrying amount of an item of property, plant and equipment must be derecognized when on the disposal. When we decide to dispose or sell the asset, we need to derecognize that carrying amount from our books. Or when there is no future economic benefit that is expected from the use of the property, plant and equipment, or when we are disposing it. So it must be derecognized. To derecognize then an item of property, plant and equipment, we are saying we are removing it from our books. Remember, when we purchased the property, plant and equipment, we have recognized it, we have recorded it in our books. But when we are selling it, what we need then to do is to remove it from our books. That's why we have that NB at the end, which says that when an asset is no longer useful to an entity and is disposed of, it must be removed from the books, and you also need to update your fixed asset register. Because remember that every time you purchase your item of property, plant and equipment, you also need to update your fixed assets register. You also need to update your fixed asset register when you depreciate the asset, together with when you recognize your accumulated depreciation, and your carrying amount is also shown on your fixed asset register. So here, what I want us to just reflect a bit on, you will see here that we have our basic accounting equation, but the priority I want us to give it to the asset. So we said asset initially in terms of basic accounting equation, it increases on the debit side. So when we bought the asset, we debited it on the asset account. But now we are trying to deal with a disposal. So we are selling it now. So which means, and we know that our asset decreases on the credit side, we might need to remove that asset on the credit side so that it is zeroed out. Because when you sell that item of property, plant and equipment, it has to be removed from your books. So which means when you take it out, it's going to be zeroed out. It won't be, there's nothing that's going to be left for that specific item. And another thing that maybe I just want us to highlight, to just refresh on before we move on. Remember that once you start using the asset starts losing value, and we call that systematic allocation of that cost. We call it what? It's a depreciation. It depreciates every year. So how do we recognize depreciation? Because we said depreciation is an expense. Expenses increases on the debit side. So you debit the depreciation expense, but what do you credit? You credit your accumulated depreciation. So accumulated depreciation, it simply refers to, it's like you are adding all previous year's depreciation. Then you get what? Your accumulated depreciation. So your accumulated depreciation, it is a contra asset account. So what does it mean? We know how an asset behaves. Asset increases on the debit side, it reduces on the credit side. But a contra asset account, it means it increases on the credit side and reduces on the debit side. That's why each time you recognize depreciation, you debit the depreciation because it's an expense. Expenses increase on the debit side. What do you credit? You credit your accumulated depreciation, which is a contra asset. And we know that contra asset increase on which side? On the credit side. Remember that when then you have to take to dispose the asset, so you need to remove everything from the books that relate to that asset. The first thing that we will need to remove, it is the cost of that asset. It needs to be removed. It needs to be zeroed out because we've disposed it. we've got rid of it. Number two, we know that our accumulated depreciation, it's also sitting in our books. It also needs to be removed. We know that accumulated depreciation increases on the credit side. So to take it out, to remove it, we will need to debit the accumulated depreciation. We will see when we start dealing with the steps that are followed. But now, as a basic, I want us to start understanding from how did you recognize the asset when it came in, what accounts were affected, because we know now that you dealt with your asset account, which at cost, you dealt with your depreciation, you also dealt with your accumulated depreciation. So when we are selling now, we also need to make sure that those accounts are cleared out. So here we are just explaining that there are different ways of disposing an asset. You can scrap it, it's no longer, you have no use of it anymore, it's like just remove it from your books, or selling it outright. You can just sell that asset, or you can do what? A trade-in as a partial payment of purchasing a new asset. So you give away the one that you have to get a better one. For example, what normally happens, I'll make a simple example in vehicles. So when you want to get rid of your old vehicle and get a new one, you can just trade in that one, the old one, and get a new one. So that is also a way of disposing an asset, because the one that you are giving away, it's the one that you are disposing, and you are purchasing a new one. So when we deal with the disposal of asset of our property, plant, and equipment, there are 6 steps that we need to follow all the time, because if you skip any of these steps, you are likely to calculate to have incorrect calculations. Number 1, the first step that we need to do is to record the depreciation of the current period up to the date of disposal of that particular asset. Let's say, for example, at this year, maybe during the year, in the middle of the year, you decided to say, you know what, I don't need this asset anymore. I need to sell it. Remember that this asset was with us for 6 months then, because if you decide halfway through the year to sell it, so it means you have to depreciate that asset from the beginning of the year up to the date of disposal. Because remember that we depreciate these assets from the date they were available for use to us up to that stage of disposal. So you need to calculate that depreciation. So what you do, you say debit depreciation, and then what do you credit? Accumulated depreciation. That's the first thing that you need to do. You will need to follow the depreciation policy of that specific entity. They will tell you. You just need to be mindful when you are doing your calculation of months. Was the asset with us the whole year, or halfway through the year, or for 9 months? It will depend. But you just need to know that first step, we need to record the depreciation of the current period, the current financial period that you are dealing with, up to the date of disposal. Then that's the general entry that you do. You say debit depreciation, you credit accumulated depreciation. So now, which means while we are still dealing with number 1, they also tell you that now calculate the total accumulated depreciation of the disposed asset. Remember that the asset that you're selling now during the year, in the middle of the year, already it had an opening balance in terms of your accumulated depreciation. Now, when you recognize this additional depreciation for the current period up to the date of disposal, then it will give you the total accumulated depreciation of the disposed asset. Because this information then, once you know the total accumulated depreciation of the disposed asset, if we go to step number 2 now says transfer the total accumulated depreciation of the disposed asset to the realization account. Now we are seeing a new concept which talks about it's a realization account. So now remember that since we are selling the asset, we're trying to get rid of this asset now from our books. So we'll open what? A realization account. This is just a temporary account that we're going to use to remove this asset from our books, and it will also help us to determine the profit or loss on the sale of this this asset. So where are we transferring this? Because now we are trying to get rid of all the details that relate to this particular asset. Now we have opened a temporary account, which is called what? Asset realization account. Remember, this account has no, it doesn't have the, it's just an account that is empty. It opened. We're just gonna use it to remove the details of this asset that we are disposing. So I don't want us to, what I'm trying to explain here is that it doesn't have this opening balance on the debit or opening balance on the credit. It's just an empty account that we are using to just remove everything that's related to the asset that we are selling. So now they are saying on number 2, transfer the total accumulated depreciation of the disposed asset. To where? To the asset realization account. Initially, I explained to say accumulated depreciation increases on the credit side. Now we are selling this asset, which means that balance of accumulated depreciation that is appearing on the credit side, it needs to be transferred to where? To the asset realization account. So how do we pass that journal entry? So we say debit the accumulated depreciation and credit what? The real asset realization account. That's why earlier I was emphasizing that we need to understand first our accumulated depreciation. It behaves. How does it behave? It increases on the credit side, reduces on the debit side. Now this requirement is saying transfer the total accumulated depreciation to the asset realization account. How do you do that? It means you need to debit the accumulated depreciation now, and you are crediting what? The realization account. We are transferring what? The total accumulated depreciation. How did we determine the total accumulated depreciation? We said opening accumulated depreciation plus the depreciation that relates to the current period up to the date of disposal of that specific asset. Here again, what I need to clarify is that you don't just take all accumulated depreciation. You deal with that specific item that is being disposed. So you will need to know what was it accumulated depreciation and what is the depreciation now, and then you get your total accumulated depreciation. That is step number 2. Step number 3, they are saying transfer the cost price of the disposed asset to the real asset realization account. Remember, when you bought an asset, what did you do? You debited that asset. You credited, let's say, if you bought it for cash, you credited bank, or if you bought it on credit, you will have credited your creditors. You raise that liability. But here we are dealing with the portion of an asset. So when you bought that asset, you debited an asset because asset increases on the debit side. You recorded in the books at what? At cost price. Now they are telling you here, they're saying transfer the cost price of the disposed asset to the realization account. So they are requesting you to zero out that asset account at cost because you are selling the assets now. Remember that asset increase on the debit side, they reduce on the credit side. So for us, what we need to do here, you will already know here that you need to credit that particular asset account so that it's reduced. And then what are you going to debit? It is the realization account. Again, what I want to stress here, if you don't know your basic accounting equation, you will struggle what to debit and what to credit. And we've seen a lot of students getting the confusion. Sometimes they will credit the realization account and debit the asset account. And it shows us that they are not understanding how how basic accounting equation functions. Then let's move to number 4. So already we can see from number 2, we said we've already eliminated the total accumulated depreciation. On number 3, we have removed the cost. Now we are moving to number 4. On number 4, On number 4, they are saying record the amount earned on the realization. Note that the realization account is credited in all 3 cases. So they show you that, so now we need to record the amount that we have earned on the realization. So they are telling you that record the amount that you have made when you are selling this asset. Because remember, we're dealing with the asset disposal. You could have sold it for cash or sold it on credit, or you will have traded the asset in. Let's take 4.1. If you have sold the asset for cash, we know in terms of our basic accounting equation, you cash, we're talking about the bank, it's an asset. So if the money is coming in, we are debiting the bank. We've got the money, we debit the bank, and then what are we crediting? Because we've sold the asset here. What you are crediting, it is the realization account. You are crediting what? The realization, asset realization account. I want to explain this point here. I'm sure some student will just be thinking to say, but we've sold this asset. Why don't we debit the bank and credit the asset account? But again, if you check number 3, we've already removed that asset from the asset account. We've transferred it to where? To the realization account, because I've explained earlier that the realization account will also it's a temporary account. We're also gonna use it to do what? To calculate the profit. So it means that everything that we're gonna be doing with this asset, it will be dealt with under the realization account. So here, if you sold that asset for cash, you are debiting the bank, you are crediting what? The realization account. You cannot credit the asset account because the asset account has already been transferred to the asset realization account. Let's say if we sold this asset for on credit, you're going to debit what? Your debtors, because if you sold it on credit, they will be owing you money. And debtors, it's an asset increase on the debit side. And then what were you going to credit? The realization account. If you traded in that asset, remember that trading in, we made a particular example of vehicles, that you have an old vehicle that you took back to the garage, and then because you wanted to buy in the new one, they say you traded in, you gave that one away to them, then you took the new one. That is trading in. So what they are saying here, what are we gonna debit? Remember that you gave away the old one, but you got a new one. So they are saying debit what? The asset account as part of the cost price of the new asset. And then what are you going to credit? You credit the realization account. In all these 3 cases, the common thing that you're going to know when you are recording the amount that you have earned on realization is that you will always credit your realization account. Credit your realization account. Credit your realization account. This is very important. So number 4, it's dealing with, these are the proceeds that you have earned when you are selling that particular asset. Then on number 5 here, they are saying now determine the profit or loss on the disposed asset. They are telling you that if the total of the debit side of the realization account is bigger than that of the credit side, the asset was disposed at a loss. But if the total of the credit side of the realization account is bigger than that of the debit side, the asset was sold at a profit. So I think this one is just straightforward, but what I like to emphasize here, you don't need to cram this step number 5 the way it's written here. We must have an understanding. We must have an understanding. Let's make a particular example that you had an asset that you bought for 100,000. The total accumulated on the date of disposal, let's say maybe it was 50,000. And then you decide to sell this asset for how much? For 60,000. Remember in this scenario, we said we bought this asset for 100,000 The total accumulated depreciation on the date of disposal, it's how much? It is 50,000, and we decided to sell this asset for 60,000. So if you were to determine the carrying amount first, how to calculate the carrying amount? You will say cost less accumulated depreciation. So which means we are left with 50,000 rand. That is our carrying amount, but you decided to sell this asset for 60,000 rand. Already you can tell that the carrying value or the carrying amount of this asset, it is 50,000 rand, but we are selling it for 60,000 rand. You are making a profit of how much? Of 10,000 rand. But let's say, for example, let's twist it around now. Let's say we sold this as the asset, we bought it for 100,000. The accumulated depreciation on the date of disposal, it is 50,000, and we decided to sell this asset for 40,000. You see now that your carrying amount is 50,000, but you sold the asset for 40,000, which means you sold it less than its carrying value, which means you have made a loss. That's what step number 5 is trying to explain here. That's why I prefer it if you just apply yourself by saying you're going to compare your proceeds to your carrying amount, so that it will tell you whether you've made a profit or not, rather than to say if the debit side, because we know that students, when they post to this account, the asset realization account, sometimes they make errors. It goes to this side and that side, and then they end up finding themselves having a profit in a situation where it should be a loss. But let's stick to the basics. How do we calculate the profit or loss on sale of an asset? We know that we need our carrying amount. We need to compare it with our proceeds. If our proceeds exceeds the carrying amount, we know that we've made a profit. But if our carrying amount exceeds our proceeds, then it means we are making a loss because we sold it less than its carrying value. Last step, number 6. They are telling you that transfer the profit or loss to the profit or loss account on disposal of that type of an asset. Remember that we close off when you do your income statement, all the item that appears in your income statement or in your statement of comprehensive income or profit or loss. So we're talking about income and expenses. We close them off. The first part goes to your trading account. So we zero them out on that trading account, which there we are just determining the gross profit, but the remainder of all those income and expenses, we close them to your profit or loss account. You will see when we do the closing transfers on your remaining unit how it applies. But here on point number 6, they are saying transfer profit or loss to the profit or loss account on the disposal of that type of an asset. So here 6.1, if we have made a profit, that profit needs to be transferred now. So what we're gonna do then, we need to debit the realization account and we credit what? Profit on disposal of that particular asset account. Remember that profit increase, it's similar to your income. It will increase on your credit side. That's when it's money coming. It's more your equity increases on your credit side. So that's why here we're saying credit the profit or loss, and then what are you gonna debit? You're gonna debit the realization account. But if you've made a loss, you will debit the loss on disposal of that particular asset account. And what do you credit? The realization account. Before we move on from this step number 6, they are telling you there's a golden rule at the end. Profit gains or losses on disposal of asset must be disclosed separately in a statement of profit or loss and other comprehensive income. So it must be shown separately. So then we're gonna go and do the we will do a class example, so where I take you to show you how we determine how do we apply those 6 steps that we just spoken about. But for now, I just want to show you the property, plant and equipment note to the financial statements. So this is how a PPE note looks like. So you will see on my left hand side, you will see at the beginning of the year, Okay, the heading that we're going to have here, we have land and building, machinery, vehicles, and we have the total. So here, we are just showing all the property, plant, and equipment items. So if on that particular scenario that you are given with the entity, they have land and building will be reflected here. If they have machinery will be reflected here. If they have vehicles will be reflected here. If they were furniture will be reflected here. If there was equipment will be reflected here. So we list all the items that form part of your property, plant, and equipment. So this is how the note goes then. At the beginning of the year, we're going to have the carrying amount at the beginning of the year, which means it is the carrying amount of the previous year. At the closing of the previous year. So then how do we determine the carrying amount? You're going to say cost at the beginning of the year less the accumulated depreciation at the beginning of the year. Then we go to movements. So we ask ourselves now, did we buy any new PPE item? Then we're going to include that as part of additions. If we did buy maybe land and building, you will have to add that amount of land and building here. If we bought machinery, you will have to add that machinery there. If you bought a vehicle, you will have to add. Then we also move to ask ourselves again on movements. Did we sell any asset in the current financial year? Because remember that the purpose of this session, we're dealing with the disposal of PPE. Yes, if we did sell. So what we need to do then, we're going to say disposal carrying value on the date of disposal. It is very important here that we're saying the disposal carrying amount on the date of disposal. How do you calculate a carrying amount on the date of disposal? You will say the cost of that particular item that is being sold less what the total accumulated depreciation when on the date of disposal. You will see that under disposal carrying value, we are deducting that carrying value on the date of disposal. Problem here, student, what they generally do under disposal, they add instead of deducting. When you are disposing something, you are getting rid of it. You are removing it from the books on what amount? At a carrying value. How do you calculate a carrying value on the date of disposal? You will say the cost less the accumulated depreciation on the date of disposal. Then we also have what? The depreciation expense for the year. Remember the depreciation expense, it should reduce what? The carrying amount. It will reduce the amount. So that's why depreciation expense for the year, we will always deduct it. We will see under machinery, that's why we have that negative X even under vehicles, because we need to deduct that. Then at the end of the year, you're also going to have what? The carrying value or the carrying amount at the end of the year. You're also going to have how to determine the carrying value or the carrying amount at the end of the year. You are saying the cost at the end of the year less the accumulated depreciation at the end of the year. What is important here? Let's say the machinery was sold. When you have to determine now the cost at the end of the year, you will say the cost at the beginning of the year. You have to add it with what? With the additions. Did you buy anything new during the year? If you bought, you add that. Then you're going to subtract the cost of the asset that you have disposed. Then you will be left with the cost at the end of the year. So I need us to pay attention to this movement. We are saying cost at the beginning of the year plus the addition, because remember that addition is talking about you've bought a new asset at what cost price? You recorded it at a cost price. Then you say, did I sell anything here? You minus that cost for that particular item. You minus the one that has been disposed, then you're going to have the cost at the end of the year. So you should be able to reconcile this. And the accumulated depreciation at the end of the year, how will you calculate it? You will say accumulated depreciation at the beginning of the year plus what? Plus the depreciation expense. Remember, when you recognize depreciation, what do? You say debit depreciation expense, you add the accumulated depreciation. So you will say the accumulated depreciation at the beginning of the year, you add it with your depreciation expense. And what are you going to deduct? You're going to deduct the total accumulated depreciation on the date of disposal. If you have sold that particular asset, it means you have removed that accumulated depreciation. It needs to be deducted from this. That's how you're going to get your accumulated depreciation at the end of the year. You will see when we do a practical example so that you follow, because students tend to mix things around here. What is important here is that we started with this cost at the beginning. These were the movement, and then we're left with this. So in this stage, you require a proper understanding how to arrive at the carrying values at the end of the year, because you know how to calculate the carrying value. You say cost less accumulated depreciation. So then how do we disclose then the balance now that you will have got in here? Because remember that at the end you have total at the end, so which means you will have said land and building plus machinery plus vehicles, you get the total at the end. So we take this amount here. This is the amount that we are concerned about, the carrying value at the end of the year. This is the one that we're going to go and disclose where on the statement of financial position at the end of the year. We say property, plant and equipment. We put that figure here, which is the carrying value. That's why we are saying here NB, only the carrying amount at the end of the year is shown in the face of the statement of financial position, so that you don't get confused and you take the carrying value at the beginning of the year. No, we are concerned with the one at the end of the year. And here on this slide, then we are saying, what question can we ask you regarding the property, plant and equipment? We can request you to prepare journal entries for asset-related transactions. We can ask you to do general ledger account, which is your asset cost account, your accumulated depreciation, your asset realization account, your depreciation account. Or we can ask you to prepare the property, plant and equipment note. And lastly, we can also ask you to disclose the carrying amount of PPE in the statement of financial position. So now I want us to go through this example, this class exercise. So we are saying B Box, the owner of Box Traders, bought a new machinery for 60,000 rand on 1 July 20.0. He decided to write off the depreciation at 25% per annum using the straight line method, or it's a fixed installment method. We've already covered this method, how we this method that we can use to calculate depreciation. They will tell you for that specific trader or entity what is their depreciation policy. But here we're being told that they are using the straight line method. So how to calculate depreciation here? So you will say the cost price less the residual value, of which if they are silent, we assume the residual value, it will be 0, multiplied by 25% times months over 12. That's what we'll be doing here. And they are telling you that on the 30th of June 20.3, the machinery bought during 20.0 was sold for 18,000. So they are telling you that this machinery that was bought on 1 July 20.0, it was sold on 30 June 20.3 for how much? For 18,000 rand cash. What is required here? You are required to prepare the following ledger accounts reflecting all applicable entries in the books of Box Traders, properly balanced or closed off at 31st March of each financial year. Show all calculations. So you are required to do what? A machinery at cost. So we know now that the new machinery was bought for how much? For 60,000. When? On 1 July 20.0. We know when you buy an asset, and we bought this asset for 60,000 rand on 1 July 20.0. Let's assume here that it was bought for cash. So what I want us to, in the question, they will tell you whether it was bought for cash or it was bought on credit. But here, let's just assume, because I think I've missed to put that it was bought for cash. They bought it for 60,000. So what journal entry we're going to write? You were going to debit the machinery. machinery is an asset. Asset increase on which side? On the debit. So you debit the machinery, how much? 60,000 rand. What are you going to credit? You credit your bank because you bought it for cash. The money went out. So we know now that cash is our bank and our bank is our asset. So if the money is leaving us and our asset decreases on which side? On the credit side, you will have credited that. Then as soon as this machinery is available for use on the 1st of July 20.0, we'll need to start depreciating by applying 25% per annum. And then we'll also need to determine the accumulated depreciation. Then we need to do the machinery realization account. We'll prepare the PPE note and we'll also, but on 5 and 6, we are saying prepare the PPE note to the financial statement for the year ended 31st December 20.4. And number 6, disclose the PPE into the statement of financial position for the year ended 31st March 20.4. We were told here that the financial year end of Boxer Traders is 31st March each financial year. So I want us to So key things that I want us to focus as we move to the next slide is that it was bought on the 1st of July 20.0. For how much? For 60,000. You are being told here it's depreciated 25% per annum using a straight line method. I want us to start there. So what I always prefer, first thing, know when the financial year ends and when it starts. It is very important. And you need to know when was the machinery purchased, the date. Does it fall into the current financial year or it falls into the previous financial years? Because here, what I just did here, I just said, okay, let's work out the timelines of this purchase machinery on 1 July 20.0. 1 July 20.0. You were told that financial year end on 31st March each year. So on year 1, the year 1 will end when? On 31st March 20.1. Why I'm saying it's going to end on 31st March 20.1. You were told here that this asset was purchased when? On 1 July 20.0. That 1 July 20.0 form part of the financial year that end on 31st March 20.0. So if a year ends on 31st March 20.1, it started when? On the 1st of April 20.0. And if you check here that on number 4, so we need to make sure for a financial period, it should have how many months? 12 full months. So April 20.0 will be our first month and 31st March 20.1 will be our 12th month. And if you check here, you will see that this new machinery was purchased in July 20.0, which form part of the first of year 1. The question that becomes important then, the asset was available for use from 1 July 20.0 for year 1 until the end of the year, which is 31st March 20.1. We ask ourselves, how many months did we have this asset under year 1? It was from July, August, September, October, November, December, January, February, March, which is 9 months. So which means when you go and calculate the depreciation for year 1, you're going to be saying 60,000 rand, because we're using a straight line method, multiply by 25%, which is our depreciation rate that has been given, multiply by months over 12, which is going to be 9 over 12, because it was only with Boxer Traders for 9 months. And then we move to year 2. This asset, year 2 starts when? On 1 April 20.1, and then it ends when? On 31st March 20.2. This asset was with us for the full year. How do we know that? Because we were told that it was only sold when on the 30th of June 20.3. So 20.3 is not yet in this financial period. So we have to say, we will say 60,000 rand multiplied by 25% multiplied by 12 over 12. The reason the asset was with us for 12 months. Let's move to year 3 then. Year 3 starts when? On 1 April 20.2 and ends when? On 31st March 20.3. You were told that the asset was sold when? On 30 June 20.3. The question is, the date of selling this asset, does it fall within year 3? It doesn't, because year 3 ends when? On 31st March 20.3, and the asset was sold when? On 30 June 20.3. So it means this asset was also with us for 12 months, starting from 1 April 20.2 up to 31st March 20.3. How do we calculate depreciation for that period? You're going to say 60,000 rand times 25% times 12 over 12. Then you get the amount that we get there. Then in year 4, what will happen in year 4? Year 4 starts when? It starts on 1 April 20.3 and ends on 31st March 20.4. You were told that the asset was sold on 30 June 20.3. So 30 June 20.3 form part of year 4. So this is the year that it was sold. The question then, if you remember the 6 steps that we spoken about earlier, we said first, calculate or record the depreciation of the current period up to the date of disposal. So this asset in year 4, it was with us from 1 April, May, and then June. It was with us for how many months? For 3 months. How do I calculate the depreciation then? You're going to say 60,000 rand times 25% times 3 over 12. It was only with us for 3 months. April, May, June. Then you get the figure that you get. Already by doing that, you will have already applied what? Step number 1, where they say record the depreciation of the current period up to the date of disposal, up to 30 June 20.3. So timeline is very important. If you don't use timeline, you will always miss how to calculate depreciation, because we need to know when was it available for use and how long have we used the asset within the business. So at least now we have a picture of this timelines. I always say every time we ask you a question about property, plant and equipment, we are trying to determine depreciation. First thing, know when the financial year starts and when does it end, and when did the transaction took place, so that you will know when to start calculating for depreciation and when to stop. So this is a depreciation schedule that we have prepared, straight line method. I've already explained this, that under year 1, that's the cost price that you have, it's 60,000. Calculation of depreciation, how do we calculate? You say the cost, because we are using a straight line method. Gonna say cost price multiplied by that 25%, multiplied by months over 12, then you're gonna get what? Our annual depreciation. Then you also gonna have what? Your accumulated depreciation. Remember, your accumulated depreciation, the depreciation that relate to the previous period. Then how do you calculate your net carrying amount? You say cost price less the accumulated depreciation. So let's start with year 1. We've already done this on the previous slide. So on year 1, the cost price was 60,000. So how to calculate depreciation? You said 60,000 times 25% times 9 divided by 12. Remember, it was only with us for 9 months. Then your annual depreciation, how much is it? It was going to be 11,250. And what was going to be your accumulated depreciation then? Remember, when you debit depreciation expense, you credit what? Your accumulated depreciation. So it will have been how much? The same amount as 11,250. 11,250. And what will be your net carrying amount? How do you calculate net carrying amount? You say cost price, which is 60,000, less your accumulated depreciation of 11,250. You get 48,750. And then what happens in year 2? The cost price will remain the same. Remember the principle that we've spoken about, that the asset, we are using the historic cost. So which means we are using the historic cost principle. The asset should remain in the books at its original cost price. The fact that you are depreciating and recognizing accumulated depreciation, it does not mean you need to go and adjust that cost price. No, we don't do that. We keep it at historic cost of how much? Of 60,000, even in year 2. So in year 2, you're going to say 60, to calculate depreciation, you say 60,000 times 25% times 12 over 12. The reason we said the asset was with us for the whole year, for the full 12 months, because we did not sell it at that time, which then we get what? 15,000 rand. which is our annual depreciation for year 2. But then what will be your accumulated depreciation? We said accumulated depreciation, we are adding all previous year's depreciation. So the previous one, we had 11,250. Now we have to add this 15,000. Then you get what? 26,250. That is your accumulated depreciation. Then what will be your carrying amount then at the end of year 2? It will be cost price less accumulated depreciation. So you say 60,000 less 26,250. You get 33,750. Then we move to year 3. Remember, on year 3, our cost price will remain the same because we are applying the historic cost principle. We kept it at its original price. Then to calculate the depreciation, we say 60,000 times 25% times 12/12. Remember, this machinery was still with us for the full year. So we're going to depreciate for the full year. That's why it's going to be 15,000 rand again. Then how do you calculate your accumulated depreciation? Already you had an opening accumulated depreciation of how much? Of 26,250. You add what? The 15,000, then you get how much? 41,250. Then how do you calculate your net carrying amount at the end of year 3? You will say 60,000 rand minus your accumulated depreciation, which is 41,250. Then you get a net carrying amount of 18,750. Then what happens in year 4? So year 4, it is the year that we have sold this machinery. So that's why here we wrote beginning of the year up to the date of disposal, which is 30 June 20.3. So we need to calculate the depreciation for that. So what is our depreciation? You're going to say 60,000 multiplied by 25% times 3/12. What do you get? You get 3,750. So this is our step number 1. When we're disposing the asset, we need to calculate the depreciation up to the date of disposal. It was here, it was with us for 3 months. Then we get how much? The annual depreciation was 3,750. Step number 2 said, on step number 1, it's also said, now calculate the total accumulated depreciation of the disposed asset. So we opened with, at the end of year 3, we had 41,250. Now we need to add this 3,750. You get what? Your 45,000 rand, which is your total accumulated depreciation of the disposed asset. What is the carrying amount then at the date of disposal, which is falling under year 4? You say cost price less 45,000, you are left with 15,000 rand. So the carrying amount is how much? It is 15,000 rand. If we go back to our scenario, you were told that this machinery was sold for 18,000 rand. Already we can tell by looking at the carrying amount is 15,000 rand, but we sold it for 18,000 rand. We've made what? A profit. So once you actually understand how to determine these figures, everything else becomes easy because our carrying amounts are sitting there, our accumulated amount is here, our depreciation, it is here. I hope we understood and followed how did we determine all this, and we also apply that timelines. Then you were required to do what? To prepare. Let me go back to the question so that you know. Prepare the following ledger accounts reflecting all applicable entries in the books of traders, of box traders. They want a machinery at cost account, they want depreciation, they want accumulated depreciation, they also want machinery realization. Let's start with those 4. So machinery, I just said here, it's an asset account. We know that when they bought the machinery on 1 July 20.0, we debit how much? 60,000 rand. Because when you buy an asset increase on which side? On the debit side. That's why we put it 60,000 rand on the debit side. What did you credit? You credited the bank because we assumed that we bought it for cash. In this situation, because I forgot to include that it was purchased for cash for that 60,000 rand. Now we know that machinery is debited. So if you were to write a journal entry, you're going to debit machinery 60,000, you credit bank 60,000. But when you go to a machinery account, you say machinery was debited by what was credited. That's why the description here, it will say bank. It won't say machinery again. Because what they're saying here, when you go to a machinery account, the machinery account is debited by what was credited. What was credited was the bank. That's the description you're going to put here, which is 60,000 on the debit side. As long as you make sure that if you have debited the machinery, go to the debit side of the machinery account. And the description, it will be what was credited. What did you credit when you debited the machinery? You credited the bank. That's why we write bank, and then the amount, it is 60,000 rand. This is CPJ. Remember that on the cash payment journal, we record all the payment leaving the business. And then, so we have dealt with there were 6 steps, guys, that we've spoken about initially. We've dealt with step number 1. We did calculate the depreciation up to the date of disposal. Now what we need to do, what you needed to do on step number 2. On step number 2, you transfer the total. Let me just go back to it so that you are not lost what I'm talking about. On step number 2, number 1, we've already calculated that depreciation. We found out it was how much? It was 3,750. Then on number 1, again, they said now calculate the total accumulated depreciation, which was 45,000. We said 41,250 plus the current year depreciation up to the date of disposal, which was 3,750, then we got 45,000. So we know that our total accumulated depreciation of the disposed asset is 45,000. Then on step number 2, they say now transfer the total accumulated depreciation of the disposed asset to the realization account. Let's deal with transaction with step number 2 now. Transfer the total accumulated depreciation of the disposed asset to the realization account. How do you do that? So we said here, you're going to do what now? You're going to debit the accumulated depreciation and credit what? The asset realization account. We go to step number 2. We are dealing with step number 2. I want us to follow the steps so that we know. This is the depreciation schedule that we have calculated. We are quite familiar what is happening here. So on machinery, we recorded the date it was received. Now, on step number 1, what we'll have, okay, I'm trying to find an easier way to explain this without you guys getting confused. Okay, let me go back here. Before we get to these steps, let me just, okay, on the date we bought this asset on 1 July, we recorded that 60,000, we are fine. Let's then move to the depreciation expense. How we're going to deal with our depreciation. Remember that your depreciation, once you start using the asset, you have to depreciate the asset. So how do we recognize the depreciation expense? We debit the depreciation expense, we credit what? Your accumulated depreciation. So on our schedule that I just showed you earlier, that we've calculated, we see year 1, our depreciation was how much? 11,250. Year 2, which is our year 2, which ends on 31st March 20.2, our depreciation was 15,000. On year 3, which ends on 31st March 20.3, our depreciation was 15,000. On year 4, our depreciation up to the date of disposal was how much? Was 3,750. So I want us to record all this depreciation into the depreciation expense account. You will see that we debit the depreciation expense. What do we credit? The accumulated depreciation. So you go to the debit side of the depreciation expense. Year 1, which is 31st March 20.1, how much was it? It was 11,250. Year 2, which is 31st March 20.2, how much was our depreciation expense? Was 15,000. Year 3, which is 31st March 20.3, our depreciation was how much? 15,000. 30 June 20.3, which is the date of disposing this machinery, our depreciation was how much? Was 3,750. So already we've transferred all this to the depreciation expense account. One thing that I want you to take away here, remember we said the income and expenses account, they get closed off to where? To your profit or loss account. So which means your expenses and income account, they need to be zeroed out. How do we do that? By transferring them to the profit or loss account. That's why you will see at the end of year one on the credit side now we have 11,250. What did we credit here? So here we've transferred that to where? To a profit or loss account. How then do you do that transfer? What were you going to debit and what are you going to credit? You will credit. To reduce expenses, you need to credit expenses. So that's why here depreciation expense, it is credited. And then what do you debit? You debit your profit or loss account. For how much? For 11,250. You will see at the end of year one, there is no balance carried down or no balance brought down because the income and expenses, they need to be zeroed out. They don't need to have balances that are being carried over or that are being brought down. The same will go with year two. Year two, we're also going to do what? You're going to credit your depreciation expense and you debit what? Your profit or loss account, 15,000. And it will also happen with even year three and year four. So that's why you will, on your expenses, you will never have the balance carried down or the balance brought down because we close off those expenses to where? To your profit or loss account. And guys, I want you to read correctly here. So for us to close off a depreciation expense account, so we are saying we are trying to zero it out. We know that expenses increases on the debit side. So to zero it out, we need to credit that depreciation expense. And what you're going to debit? Your profit or loss account. So that's what you do with your depreciation expenses. So if you followed from the schedule, that's how we transferred it here. Already step number one was calculated here. We did calculate the depreciation up to the date of disposal. We found that it was 3,750. Already, because we've done with the depreciation expense, let's just go straight to deal with your accumulated depreciation. Remember, we said accumulated depreciation it's a contra asset account, it increases on the credit side and reduces on the debit side. I want us to start with year one. We know the depreciation that we calculated in year one, it was 11,250. So you say credit your accumulated depreciation. How much? 11,250. And then the description you're going to write here on the credit side, it will be your depreciation expense. The accumulated depreciation is credited because of what was debited. What did we debit? We debited the depreciation expense. That's the description you're going to write here. I'm avoiding students writing accumulated depreciation being credited by accumulated depreciation. No. When you credited accumulated depreciation, what did you debit? We debited the depreciation expense. That was year one. So the end of year one. So because we know this is an account balance, it forms part of your balance sheet. So we know now that what we need to, it will have a balance carried down or balance brought down. So we need to make both these sides be equal to what? To 11,250. So we know that credit side is already having 11,250. So we go to the debit side, we say 31st March 20.1, which is year one. We say balance carried down. How much is it? 11,250. So both sides now are equal. And our balance carried down of the previous year becomes the opening balance of the current year. So that's why here we are saying 1 April 20.1, which is year two. The balance that has been brought down is how much? It's 11,250. That is the opening balance on which side? That is the balance brought down. Remember your balance carried down that was posted on the debit side, it becomes your balance brought down on the credit side of your accumulated depreciation account, which is how much? 11,250. And then we know at year two, our depreciation that we've calculated already, it was how much? 15,000 rand. Year two, if you remember correctly, our schedule, you will see that we calculated a depreciation of 15,000 rand. And then you will write a description here. It was depreciation expense, general, yes. of how much? 15,000. So you had an opening balance now in year 2 of 11,250 plus 15,000 rand. It amount to what? 26,250. That is our accumulated depreciation. This figure also speaks to the schedule that we've prepared earlier of depreciation. So now we need to make sure that the debit side, the credit side is equal to the debit side, and on the debit side there was nothing. So to make these sides to be equal to 26,250, we need to have 26,250 even on the debit side, which we'll call that 26,250 on the debit side our balance carried down of how much? 26,250. And our balance carried down of the previous year becomes the opening balance on the next period. So our next period will be opening balance on the first date will be 1 April 20.2, and our balance brought down will be how much? 26,250. And on year 3, then we had a depreciation again of how much? Of 15,000 rand. That's why we say accumulated depreciation is credited by 15,000 rand, because we debited the depreciation expense of 15,000 rand. Then when you add 26,250 plus 15,000, you get what? 41,250. If you can go back to our schedule that we've prepared, we had an accumulated depreciation of how much? 41,250. But now we need to make the credit side equal to the debit side. How is this going to happen? So we need to have what? A balance carried down on the debit side of how much? Which is equal to 41,250. So both sides now are equal. Then we said the balance carried down on the debit side of the previous year becomes the opening balance of the current financial period, which are at the beginning of year 4, we have an opening balance of how much? Of 1. Our opening balance here on 1 April that has been brought down is how much? It's 41,250. Then in year 4, we calculated a new depreciation up to the date of disposal. So we're saying debit the depreciation expense, and then what do you credit? Your accumulated depreciation of the machinery by how much? 3,750. So when you add the opening balance that has been brought down of 41,250 plus 3,750, you get 45,000. And we know that these sides must be equal. 45,000 that side, and on the debit it will also be 45,000. But they told you here that on 30 June 20.3, the machinery was sold. So I want us to go back now so that I will show you that now you are no longer having what here on the debit side, the balance carried down, but we are having what? A realization of machinery. How much is it? 45,000. Why are we saying now your accumulated depreciation is debited by realization of machinery? It's because of this requirement. Step number 2, you were told to transfer the total accumulated depreciation of the disposed asset to the realization account. We said what you're going to debit? Your accumulated depreciation, and you credit your realization account. What did we do here? You will notice here that our accumulated depreciation of the disposed asset was 45,000, but now there's 45,000 on the credit side, but now they're saying transfer that to the asset realization account, which means then our accumulated depreciation need to be debited, and what are you going to credit? The realization of machinery of how much? 45,000 when on 30 June 20.3, which is the date of disposal. So it simply tells you now that since you no longer have a balance carried down, it's telling you that this machinery's accumulated depreciation has been removed from the books. It has been removed from the books. And so we've dealt with step number 1, we've dealt with step number 2. Now we need to move to step number 3. Let me just go back to step 3 so that we know. Step 3, they say transfer the cost price of the disposed asset to the realization account. So how do you do that? Remember, we said you're going to credit the asset account. What are you going to debit? The realization account. Let me show you then how we did that here on machinery. When we bought this machinery, we posted it on the debit side. But on step 3, they are telling you that transfer that cost now of the machinery on the date of disposal to where? To your asset to the realization account of that machinery. So which means they are telling you that to zero out this account. How do you do that? So then it means the machinery need to be credited. And what way you gonna debit? Your realization of machinery. That's why you go to the new machinery, you go to the credit side, you put how much? 60,000, because we know asset decreases on the credit side. That's why we're going to put that 6,000 on the credit side. And then the reason will be realization of machinery, because here you credited the machinery, we are removing it from the books. What did you transfer it to? To the realization of machinery account. So we've done with step number 3. So 1, 2, 3 steps are done. So another thing that I want to us to know. Let's start with this one. So I want to show you how you're going to post then on your realization account. Here you said machinery is credited by 60,000, and what did you debit? You debited the realization account 60,000. So you go to the realization account now. On the debit side, you say that new machinery at cost price, you debit by 60,000. Because we said there, machinery cost was credited by 60,000, we debited the realization account. When you go to the realization account, you go to the debit side, you put that 60,000. The same will go for your accumulated depreciation. Accumulated depreciation, we said it is debited by how much? By 45,000. And what did we credit? We credited the realization account. When you go to the realization account, you say machinery realization account is credited by how much? By 45,000, because we have debited the accumulated depreciation on new machinery. By how much? By 45,000. So step 2 and 3, we've already transferred to the machinery realization account. What else are we left with here? Okay, so step 2 and 3, it's done. We need to move then to step 4. I want us to go back to step number 4. What is required of us for step number 4? Record the amount earned on the realization. So they show you that there were 3 methods, but what is important here, you will always credit your realization account. If you sold that machinery for this machinery, we're told that it was sold for cash. So 4.1 is applicable here. We are debiting the bank, and what are we crediting? The realization account. For how much? It was sold for 18,000 rand. Remember here, we're told it was sold for 18,000 rand cash. So when we go to the realization account for step number 4, we're saying you're gonna, when you sold it for cash, 18,000, you debited the bank. What did you credit? You credited the machinery realization. That's why you now go to the machinery realization. On the credit side, you put 18,000 rand. And this 18,000 rand, the description that you write here, it is bank, because you credited the machinery realization because you have debited the bank of how much? Of 18,000 rand. Then if you, before we do step 5 and 6, already you can see on the debit side, we have 60,000 rand only. Just ignore this 3,000 rand because I haven't shown you how to calculate it. Then on the credit side, you have 45,000 rand. You also have 18,000 rand. So already you can see what if you add 45 plus 18,000, you get 63,000. So which means the credit side is greater than the debit side. We've already have 60,000 here. So both sides must be equal to the amount that is higher, which means in this case, on the debit, we have 60 only. On the credit, we have 45 plus 18, which is 63. So both sides must be equal to 63,000 rand. And then you will realize that how then do we get to from 60 to 63? We are short of 3,000 rand. Where did we get this 3,000 rand? You will see it a profit on disposal of a new machinery. So this is what I want us to, so that you will know, because this is what they were explaining on step number 5. If that side is greater than what you will have a profit. If this side is less than what you have a loss. That's what they were explaining on step number 5. If you go back and revisit step number 5, but I want to show you a simple way of determining this 3,000 rand. The machinery was bought for 60,000 rand. It accumulated depreciation on the date of disposal is 45,000 rand. And what is the carrying amount of this machinery on the date of disposal? We've already calculated it to be 15,000 rand, because you're going to say 60,000 rand less 45. You are left with 15,000 rand. And then you were told that this asset was sold for 18,000 rand. An asset that has a carrying value of carrying value of 15,000 rand was sold for 18,000 rand, which means it was sold for a profit of how much? Of 3,000 rand. This is the 3,000 rand. That's why you will say here, machinery on realization, it is debited. And then what was credited is your profit on disposal. That's what we explained on step number 6. That's why you come here, you put this 3,000. So you are done with your machinery realization account. We said this account is a temporary account. It does not need to have balances carried down and balance brought down, and we don't have it here. So it's very important to know how those step flows, because you miss any, you will be in trouble. You won't know how to. So we done the requirement 1, we done requirement 2, we done requirement 3, we done requirement 4. Now, I want us to go straight to do requirement number 5 and 6. Number 5, you are required to prepare a PPE note, property, plant and equipment note. And then on number 6, you are required to disclose that the PPE into the statement of financial position. So I want us to move quickly before I run into load trading again. This is our PPE note. I've included it the way it was, but now they were specific that for which year. They said prepare the PPE note to the financial statement for the year ended 31st March 20.4. Year ended 31st March 20.4. So if the year ends on 31st March 20.4, it started when? On 1 April 20.3. We've already made that, we figured that one out. It started when? On 1 April 20.3, then it will end on 31st March 20.4. I think there's an error there at the end there. It should be 20.4. It should go to 20.4444, yes. So, but anyway, let's move then to. So the carrying amount at the beginning of the year, which is 1 April 20.3. Where did we get that carrying amount? How to calculate the carrying amount at the beginning of the year? I want us to only focus on machinery. The cost price at the beginning of the year, 1 April 20.3, it was how much? 60,000. Remember that we applied the historic cost model with principle which says keep the original cost price of that particular item. How much? 60,000. If you less the accumulated depreciation at the beginning of the year, 1 April 20.3, it was how much? 41,250. It here. Year 3, end of year 3, we had how much? 41,250. So the accumulated closing balance of the accumulated depreciation at the end of year 3 was 41,250. But now we are at year 4, so it becomes the opening balance, that 41,250. 41,250. So when you say 60,000 rand minus 41,250, you get what? A carrying amount of 18,750. There it is. At the beginning of the year. Remember, at the beginning of the year, we are using the balances of the closing balances of the previous year, because those are your opening for the next year. So which is 18,750. Then the total, how to determine the total? You just add land, building, machinery, vehicles to the right hand side. Then you'll get the same, because this was only machinery. Let's go to movement. Did we buy any machinery? No, we did not. That's why we have a 0 here. Did we buy any land and building? No. Then we move to what? We're gonna say less what is our depreciation? But remember, guys, here I want our depreciation to be, we need to put it always here at the end, the way I have shown you the note. But for the sake of just doing this exercise, we know that the depreciation up to the date of disposal was how much? 3,750. We minus that 3,750. Then less the disposal at the carrying amount on the date of disposal. What was the cost price of the asset that we are disposing on 30 June? It costed us 60,000. What is the accumulated depreciation on the date of disposal? How are you going to calculate that? Because we said 41,250 plus 3,750, we got 45,000. If you go back to this schedule, we know that after determining this depreciation of 3,750, we already had an accumulated depreciation of 41,250. If you add these two, you get 45,000. That's why we have that 45,000 here on the date of disposal. If you say 60 less 45,000, you are left with 15,000 rand. But here, remember, at the beginning here, we're saying less disposal at the carrying amount on the date of disposal. Disposal carrying amount, you say cost price less accumulated, we minus that 15. Student always make a confusion by adding this 15 instead of deducting it. It deducts that. Then at the end of the year, remember this asset has been sold, has been removed from our books now. What will be our carrying amount at the end of the year? How do we determine that? We need a cost price at the end of the year. Remember how we're going to do it. You will say cost price at the beginning of the year plus additions. Did we buy anything? You know. But did we sell something? What is it that we sold? What was its cost price? We sold it. We sold that asset that costed us 60,000. So you are saying 60,000 plus 0 minus 60,000. You'll be left with a cost price of 0 at the end of the year. Then what will be your accumulated depreciation at the end of the year? We open with an accumulated depreciation of 41,250 plus 3,750, because the depreciation you added to the accumulated depreciation. Then already, if you add these two, you have 45,000 less the accumulated depreciation of the asset that we have sold, which was 45,000. So it's like 45,000 less 45,000. We will have 0 accumulated depreciation at the end of the year. So what will be the carrying amount at the end of the year? It will be 0 minus accumulated depreciation of 0. Then you end up with 0. It shows that this machinery has been removed in the books now. It's no longer there. We just need to take it out. It's no longer there. It shows. And then the figures will also be the same at the end, the totals, because we're only talking about machinery. But if there were other figures here for land and building and vehicles, it would have been different. So we know now that the carrying amount at the end of 31st March 20.0, it is 0. This is the 0 that we're going to go and disclose where in our statement of financial position as for our property, plant and equipment. You were required to do that. So this is our statement of financial position for the year ended 31st March 20.0. Under asset, you go on non-current asset. That's where we disclose property, plant and equipment. And the answer is 0 because we don't have any property, plant and equipment on this example. Students, let us end right there for today. I hope you will be able to follow. Please replay the video until you are sorted. Thank you. Yeah, we've come to the end of this lecture. Thanks, bye. Joseph, please end the session.